A very good morning, good afternoon, ladies and gentlemen. My name is Axel Threlfall. I'm editor-at-large at Reuters, based out of London, and I'm thrilled to be moderating another part of the energy webinar series. Our webinar today is entitled Embracing Change, the Future of the Energy Industry. So a grand topic, a big topic. It is hosted by the Al-Attiyah Foundation in partnership with Refinitiv. Before we start, as always, let me do a little bit of housekeeping. For any technical issues, click the help button and someone will quickly attend to your need. For any questions for our speakers, click on the Q&A tab. And please note, in the interest of time, I might not be able to get to everything, but please do send your questions through and I'll do my best. During the session, we've got two polling questions. Just follow the instructions on the screen and I will provide the responses to that. Finally, a recording of this session is going to be available using the same event link. Right, a little bit of context before I introduce our speakers. All of you know the context, I'm sure, pretty well, so I'll keep it brief. Big picture first. According to the IEA, global electricity demand was down 5% last year, the biggest drop since the 30s global crisis. All fuels saw a decline except for renewable energy, up 1%. We did see some recovery, at times pretty robust, in oil demand last year. The rebound slowed considerably in November and slipped again in December, but support appears to be coming back. I'll come back to that in just a second. Natural gas, on the other hand, has seen pretty steady support given the cold winter in North Asia, outages at major LNG exporters, as well as shipping constraints. Spot prices in Asia up 18-fold from April 2020 lows. We've heard of course, a lot about a pretty hefty fall in greenhouse gas emissions last year. The debate now, of course, is whether we'll see any lasting change in emissions once economic growth returns. The consensus seems to be that new policies will be urgently needed if we're to see any meaningful structural decline in emissions. Finally, a quick look at the very latest from the Reuters wire. As I said, a positive momentum seems to be returning to oil markets. Prices up more than $1 on Tuesday. Vaccine optimism, the US freeze, of course, providing support. Most think a summer pickup in demand will take out what is left of that supply glut. Goldman now predicting $70 a barrel Q2, $75 in Q3. Right. That is the context. Let me introduce our speakers and we can throw some of these ideas around. Remember, send your questions in whenever you want to. Michael Grubb is Professor of Energy and Climate Change, University College London. Paul Stevens is the Distinguished Fellow at the Royal Institute of International Affairs, Chatham House. And Robin Mills is founder of Kamar Energy. All three speakers also hold the title of Distinguished Fellows of the Al-Attiyah Foundation, having worked extensively with the foundation over the past few years. Before we do get into the discussion, I want to invite Robin to deliver a short presentation on the energy industry. This presentation, by the way, will be available to all attendees on the Al-Attiyah website, which is www.abahfoundation.org. Right, over to you, Robin.
Great, thank you, Axel, for the introduction, and good afternoon, good morning, everybody. Thanks for joining us here. So I'd like to give a short presentation focusing on the changes in the energy industry, and in particular the implications for the Middle East and for the Gulf countries as still the world's most important oil and gas producers and exporters. And I've got 6 minutes of this, which is not long to cover such a big topic. And conveniently, I've got 6 pillars, so I'm going to have to try to deal with each of these in 1 minute. What I've tried to identify is the emerging response from the Gulf countries to the changing energy future and how that is shaped around 6 pillars. So far, I see these moving from left to right as the more traditional, more familiar parts of the energy industry on the left, the more novel parts on the right. So on the left, we have the pillar of OPEC Plus cooperation, trying to work together within the OPEC Plus framework to go with Russia and other countries to manage market share, manage supply, manage prices. And at some point, the organization will have to transition to trying to defend prices, to kind of retain market share in the face of, in the longer term, a possibly shrinking market. The second pillar is the downstream, so expanding into refining, petrochemical, including overseas, targeting major new markets, Asia, particularly China, India, and the other emerging Asian countries. The third pillar is gas, doing more in gas domestically, in terms of adding value to gas at home, but also, of course, in some countries, expanding gas exports, developing both conventional and unconventional gas. That's a growing theme in the Gulf. The fourth pillar being carbon capture, use and storage to reduce emissions and to clean up the local oil and gas industry and the power sector and industrial sector of home, possibly turning that into a further source of economic value by becoming a center of removing carbon dioxide from the atmosphere through direct air capture. The fifth pillar, and a new one, an emerging one, is hydrogen, producing so-called blue hydrogen from fossil fuels and possibly green hydrogen from renewable energy, using that to produce hydrogen for export, ammonia, low-carbon steel and other products. And the final pillar, renewables. Solar, mostly, not surprisingly, in the Gulf, using that as a lever for domestic decarbonisation and for reducing electricity costs and perhaps driving industry at home. And all of these pillars are being pursued in different ways by the different Gulf countries, but they also all face challenges. And there's a question of how much any one of these, or even all of them together, can cooperate and can coordinate and can replace the very high rents and value that has been derived from fossil fuels over the past 50 plus years. There are some other obvious pillars that are getting less attention. Perhaps the most obvious one is energy efficiency. Yes, there is some attempt on energy efficiency, hard to call it an emerging pillar at the moment. And the other key area for me is the area of new energy technology development. There's a lot of deployment of new energy technologies, but is there enough domestic development within the Gulf countries of technologies that meet their needs? I'm just going to tackle each of these pillars very quickly in a little further. And just to remind ourselves, what actually is the challenge here? Well, the scale of the challenge is that we have 3,000 potential in fossil fuel reserves, but we only have somewhere between 460 to 1,200 gigatons of carbon budget if we're going to hit a 1.5 or a 2 degree target for warming. If you believe if you're aiming for the 1.5 degree target, you could burn about half of our global oil reserves and nothing else. If you believe in the 2 degree target, you could burn the oil and the gas, but not of the coal. Of course, we're very actively burning coal today in China, India, and elsewhere. So this is an enormous challenge. A large part of these reserves, these resources, cannot simply be burnt as we've been doing so readily over the past century and more. What can we do about this? Well, we can focus on lower emitting resources, switching from coal to gas. We can introduce carbon capture and storage in end uses. We can try for non-emitting uses like petrochemicals. We can have other techniques for bringing down carbon dioxide in the atmosphere like biosequestration, forestry and so on, or direct air capture, technological means to take CO2 from the atmosphere. But all of these together they all have their limitations and their challenges. And I think it's, even if these are all pursued very actively, it's inevitable a lot of these fossil fuel resources will never be produced. And from a Gulf point of view, of course, we'd hope that most of what doesn't get produced and used is coal, which would allow the Gulf to produce more of its oil and gas. But, realistic, some of this oil and gas is at threat as well. In the short term, the OPEC Plus cooperation has been very successful in avoiding a more severe drop in oil prices and bringing back prices quite successfully, but it has resulted in a significant drop in OPEC Plus market share. How quickly will that be regained? If as BP suggests, we might have passed the all-time peak, I personally don't think we have, but we will say that the peak in oil demand probably is not too far off. When will OPEC Plus regain that market share? And when will it move to actually increasing market share versus high-cost competitors? Or will there be a tendency to try to defend price? This, I think, is key for how much of those fossil fuel resources remaining are produced by the Gulf countries and the OPEC Plus countries versus others. I mentioned downstream. Downstream integration has promised for many years to add value. But again, in a world of peak oil demand, there are challenges of overcapacity, stranded assets. Does it make sense to be putting more money into refineries in a market like China, which is committed to a zero carbon goal by 2060? As you can see from this chart, the Middle East and other regions are adding almost 8 million barrels per day of refining capacity just over the next few years up to 2023. Yet by 2040, the refining system globally has to shrink by 10 million. So someone else, and some of that will be Europe, some of that will be other high-cost OECD countries, will have to shut their refineries. It suggests a long period of overcapacity and low margins. I've talked about CCUS. That's obviously an absolutely critical topic for using fossil fuels. We have seen significant moves in some of the GCC countries to expand the use of CCUS in the past year or so. The technical potential, as I show here, is huge. A realistic technical potential on some of the major emitters, more than 140 million tons of CO2 per year by 2035. Realistically, at the moment, we're looking at about 11 million from current plans by 2026, and you can see that's only a small fraction of the technical potential. So if CCUS is to be used widely in the Gulf, it has to move ahead quickly. I mentioned also hydrogen. The Middle East has the potential to play a major role in future hydrogen demand. There's great interest in Europe and Japan in hydrogen as a clean fuel which meets a number of needs in the energy system which renewables and electricity alone can't meet. The Gulf countries are certainly well placed in terms of producing low-cost hydrogen. They are not the best placed in the world, I would say, but they're certainly well placed. Well placed in green hydrogen through wind and solar resources and a suitable geography. Well placed in blue hydrogen through having large fossil fuel resources at low cost, large carbon capture and storage potential, and again, a good geography for exports. And you can see the chart on the right showing Middle East blue hydrogen production costs as amongst the lowest in the world. And we've seen encouraging movement on this over the past year or so in terms of real hydrogen projects being announced and starting to move forward. However, again, hydrogen is certainly an interesting industry, but unlikely to be one that will generate the same value as oil and gas resources have generated over the past decades. And very strong growth in solar is possible. So again, we've shown here the growth, forecast growth in solar power in the GCC. By 2035, we could have something like, or by 2030, we could have as much solar as China had in 2019. So the GCC is a very large potential solar market. Again, this is certainly excellent for decarbonizing the domestic economy. It'll bring down power prices. What will it create value in terms of export industries? There can be exports of electricity. There can be exports of materials produced with low carbon electricity. That's certainly valuable and worth exploring. But again, it's challenging to make for that to add the same value that hydrocarbon exports have added. There are also various other policy challenges to bringing in renewables. So all of these pillars together are valuable. They're all worth doing. They're all being actively pursued. And together that they provide part of the solution to the challenge the Gulf has of a world of constrained fossil fuel exports, overcapacity and likely in the long term falling demand and falling prices. They're each part of the solution, but there is no magic solution. And much of the solution to this challenge will inevitably have to come outside the energy industry as well as within it. So that was a very quick run through of a deep and challenging topic, and I'm looking forward to hearing from my fellow panelists on their thoughts on meeting these challenges. Thank you.
Okay, thank you, Robin. Look, I've got a very quick follow-up question for you, Robin, a general question before we get into the panel. We've got the March meeting of OPEC, of course. The Saudi oil minister has come out and said, don't try and predict the unpredictable, making it quite hard for people trying to read this market. Saudis and Russians seem to be at odds. What do you think we're going to get at this meeting?
Well, I think Prince Abdulaziz is kind of delighted in trying to wrong-foot the market and indeed surprise them, and that's a tactical thing in a way, trying to burn the speculators as he suggested. But I think the trend, and particularly with the US snowfalls and so on, cutting back on production there, and the oil price rising quite strongly, I think we'd expect to see a further round of production increases, And I've been saying for a while that the OPEC Plus group needs to be getting back to regaining as much market share as it can, as quickly as it can, even if that is keeping prices a bit lower.
Yeah. Okay, Robin, thanks a lot. Look, we've got some questions coming through already from the audience. These are quite general, so let's start big picture. And Paul, I want to start with you. You know, the wild gyrations we've witnessed in the energy markets, in pricing over the past year, testament, are they not, really, to just how difficult it's going to be to guess or to analyze effectively how things are going to pan out? In a nutshell, where do you see things going?
It's very difficult to tell, which is a very unhelpful answer. The reason it's difficult to tell is because we don't know how much of the fall in oil demand is the result of behavior, which is likely to change. In other words, the fall in oil demand came about because of change in behavior. Some of that imposed by government, some of it the choice of consumers. And the question is this a blip, or does it represent a major discontinuity? And it's too early to tell yet. For example, transport accounts for 60% of liquid oil demand globally. Now, given the change in working practices, are those changes going to continue, or are people going to go back to how it was before? And it's impossible to judge that at this stage.
Yeah, okay. Michael, I mean, it seems to me, and based on what Robin has just said as well, when we look at the oil market generally, market rebalance has been completed earlier than expected a few months ago. Strong recovery in manufacturing, progress on vaccinations, the hurricane disruptions, extra output cuts by OPEC Plus. Yeah, other than jet fuel, this rebalancing has happened pretty quickly. Is that a shape of things to come?
Well, I think this is one of the weird areas in which it seems far easier to predict the long term than the short term. And I think, as Paul and others said, I mean, my area is more on the long term and the shape of the energy transition and the drivers on that. And I don't see any fundamental changes other than the fact that the acceleration, that the transitions towards low carbon options and the drivers for it seem to be accelerating. Now, what that does to the energy markets in the short term and the interest of Gulf producers is incredibly difficult to know, because the interests there are over periods of a few months to a few years, and what all of the science and indeed the goals of the Paris Agreement are basically on the timescale of the trajectory over a few decades. So I think that's the real challenge that the industry has to manage, is how do you behave in a world where you can see the long term, but it's very hard. You can see the long term if you have your eyes clearly fixed on the evidence and the accumulating processes. But that doesn't solve the question about what's the best strategy in the short term.
Yeah, okay. What actions would you advise oil and gas companies to take today to advance a low-carbon future? What sorts of low-carbon technologies should they prioritize investing in?
Well, maybe if I say just a few words about the evolution of the climate issue, because this is now not a new topic. It's been running for over 30 years, since the first UN panel report expressed concern, the launch of negotiations, and it's been a slow-moving beast. But what I can certainly say is the first piece of advice is take an objective look at the science and the accumulating evidence, and also as that gets represented through these very ponderous but very important reports of the Intergovernmental Panel on Climate Change. It's just gearing up to its 6th assessment. Each assessment takes 5 or 6 years. And the science is certainly not getting any better. Most scientists would argue it's getting worse. We've been sort of grinding out our way, not exactly towards a cliff edge, but towards an accelerating slope You can just see the level of concern and worry in the scientific community. And they're saying, we're not doing enough. We're not doing it quickly enough. This is getting more and more dangerous. We see more and more evidence of impact unfolding around the world. There's new evidence around the economics of those impacts, which is saying that economically the damage of extreme events is much bigger than had been predicted. So the first base is just take an objective look at the science and don't confuse that with whatever one's lobbying stance is or whatever one would wish to believe. Then I think the other thing I'd flag, and what really is emerging new, I think, in these rounds of assessment, is the sense that the solutions are accelerating. Almost everyone's been taken surprised by the solar. In effect, it is a solar revolution. That is the most dramatic one. It's blown out of the water almost every prediction on whether either cost or the pace of growth. Of course, globally, it's still pretty small, but if you're at 2-3% of global electricity and growing at 40% a year, you can do the maths. In a decade, completely disrupted electricity market everywhere.
Michael, I'm going to talk because I want to come back to the specifics on renewables, and I know you've done quite a bit of work on this. But so let me come back to that. Paul, very quickly though, we talk about. I asked Michael what the best, what are the best technologies. Let's just look at the oil majors, the big oil companies, and I wonder to what extent oil and gas producers, in your view, can remain profitable as net zero businesses. I mean, can they? What's the future for them?
The short answer is probably not. If you look at the history of the international oil industry, in the 20th century, the major oil companies became major because they were very good at creating economic rent and then capturing a large share of it. And that's why they became very large and powerful, because they were able to satisfy their shareholders. The problem is, as they diversify into renewables, there is no economic rent in renewables. People make money out of it, of course they do, otherwise they wouldn't be investing in it. But they're not going to make the sort of money that the oil companies were able to make out of the production of crude oil. Therefore, the oil companies are going to struggle to keep their shareholders happy. And at some point, you're likely to see a sort of stampede away from the major oil companies. If you then add to it the fact that, again, if you look at the history of the oil companies trying to diversify, it's not very good. If you go back to the early 1980s, they decided that oil was finished and they started to diversify. They began by going into gas, then to other energy sources, then petrochemicals, then food. And then they got silly and went into supermarkets, and Gulf Oil actually bought a circus. And after about 10 years, they realized they were not very good at running these sorts of industries. So I think the prospects for the major oil companies are not good at all.
All right, Robin, I know you wrote a recent report for the National on the super major oil firms and the increasing divestment. What's your thought on where they go over the next 5 years?
Yeah, look, I mean, I think there's a really interesting to see a very sharp divergence between the major oil companies. You have the Americans who are largely pursuing a fossil fuel future. They're doubling down on oil and gas and particularly shale resources. You have the Europeans, if you think about BP, Shell, Total, and so on, who are really stressing that they will be net zero carbon by 2050 or so, and that'll mean doing a lot more solar, wind, batteries, and all these other technologies. And then you have the major national oil companies whose job is to safeguard national hydrocarbon resources, and they can do that in a cleaner way. And perhaps they do some low carbon technologies as well. But I mean, basically, their value lies in their stewardship of those national oil and gas resources, and they have to make the most of them in as climate friendly a way as possible. So there's real divergence between those three. And I think the Europeans are kind of meeting the blunt edge of this problem the soonest, and indeed it is, as Paul stresses, it's an extremely big challenge. I think in the paper that I wrote, I was also trying to point to the opportunities, but also the challenges of companies that are getting out of oil and gas, If everybody tries to get out of oil and gas at the same time, who do they sell their assets to? If you sell an oil-producing asset to somebody else, you haven't reduced emissions, you've just simply transferred them. But that, of course, that requires that there's a willing buyer somewhere. And I was trying to ask the question, who is that willing buyer, if anybody?
Yeah. Very quickly, I talked to Michael about rebalancing and where we got to in this. Which fuels and markets are seeing the fastest recovery in terms of demand, supply, and prices now? Well, have been since the beginning of this year.
Yeah, well, I mean, we've seen a tremendous recovery in gas, of course, and particularly in LNG. That's a little bit idiosyncratic, I think, why the LNG market came under such a crunch. But, we incredibly had record low LNG prices in the summer. We had record high LNG prices in the winter. So really incredible volatility. But I think that there's more optimism now about the LNG market than there was. Oil, we're really at the stage of recovery, and prices are looking a lot healthier, but still big question mark over long-term oil demand, and will we regain what we lost to the pandemic, and if so, how soon? Coal, I think coal gets a bit of a boost because China has been doing better than most other countries, but China I think is keeping coal alive a little bit longer, but coal is clearly the most threatened in the short term. And then renewables have sailed through this with some interruptions of renewable projects, but overall renewable output has hit records because with almost zero variable cost for renewables, doesn't matter how low demand goes, renewables will be the first power source in the stack that everybody turns on.
Yeah. Okay. All right. Thanks, Robin. Look, I want to move to the first of the polling questions. I mean, because you were talking about LNG there at the start, and this relates to that. Which sector? This is the question. So, which sector will be the most substantial contributor to an increase in global LNG demand in the next 2 to 3 years? Power, industry, transport, residential, commercial, LNG bunkering, or you don't expect an increase in LNG demand? So have a crack at that, and I'll bring you the results in the next few minutes. But while you're having a crack at that, just a really quick follow-up to you, Robin, and then Michael, I promise you and Paul, I'm going to bring you back in. I think it was the CEO of Texas LNG who said recently that a number of the big financing institutions to the majors are ignoring investment into gas demand. Is that true, and why do you think that's happening?
Yes, well, Vivek Chandra, the CEO you refer to, he's a good friend, former colleague of mine, so I know his views on this very well. And I think it's interesting how much gas has suffered the attention of environmentalists over the past few years. Before that, it was all about coal being replaced by gas, and that's great. But gas has really the last few years suffered attention and been described by many as even worse than coal, which I don't think is true, but it's come under that attack. And you see major financial institutions now saying that they won't finance any fossil fuels, even gas where it would be replacing coal or even capturing flared gas, which seems like an obvious environmental win. Gas does face significant challenges. But I still think there's enough major companies who like gas, who think gas has a future, at least over the next 20 years, to want to invest heavily in it if they can do their best to clean up the environmental footprint as far as they can.
Yeah. Okay. Let's take a look at the result of this poll question. See where you've voted. Here you go. Power, so electricity generation, comes in at top. No great surprise there, I guess, at about 79%, and industry at 10.5%. Paul, should we be surprised by this? I don't think so, right?
Okay. No, you shouldn't be that surprised by it. But I'd like to make an important point here. We're talking about energy markets as though they are global. And I think increasingly we're going to have to think in terms of differentiating between OECD and non-OECD, because a lot of what's going to happen to energy is going to be linked into government policy decisions. And that is going to be very different between those two parts of the world. So I think this idea of talking about global markets is going to become increasingly more difficult.
I think, it's an important point you raised here, and I want to broaden that into the economic and geopolitical implications of what OPEC is doing right now. I think it's India shifting imports from, towards Africa and North America now. Clearly, there are shifts happening. Clearly, shifts will continue to happen. What are the implications, economic, geopolitical, of these continued production cuts for energy security, I guess, more than anything?
I think, again, you've got to take account of the differences between the regions. The geopolitical implications of the energy transition are huge. If you look at the 20th century, energy geopolitics was dominated by who had access to the resource. As we move into a world where oil is becoming less important, that no longer matters. And the result of this is that you're going to have a sort of much more peaceful world. But getting there is going to be difficult because the energy transition itself will be extremely disruptive, particularly for the oil producers and particularly for the oil producers of the Middle East and North Africa.
Okay. Look, I want to move it back to renewables. We talked a little bit about some of the renewable trends that we should keep an eye on this year. Michael, I know that the We Mean Business Coalition and UCL have done quite a lot of work on trying to find out where this exponential growth that everyone's talking about in renewables is going to come from. What have you found? You know, how should policy and business harness the opportunities and what we're seeing so far?
Well, I think a few points on that. One is that the work you're referring to was stimulated partly by realizing, first, that every projection that had been made about renewables, and particularly solar, had been proven wrong and inadequate by the pace of events over the last decade. And second, that actually it's a common pattern in history that people tend to just not understand the dynamics of these kinds of transitions because they can be very slow to get going. The technologies are a bit iffy, they're different, they don't fit well. But once the basics are cracked and there are competent industries that have engineered down the costs, there are markets at scale, things can take off very fast. And we simply tried to chart what does that look like. And I mean, the conclusion was there's still quite a bit of uncertainty, but I guess the headline was that now we've moved from a situation over the past decade where the new renewables, just wind and solar, had been about 2% of global electricity. Now they're around 8, maybe 9% last year of global electricity. And the solar component's been growing on average over 40% a year. And what that means is it's entirely possible, because one thing I do know is it ain't going to be a linear growth and it will be more towards exponential because the stuff is cheap. That probably means that those new renewables could look at taking 30% of electricity within this decade. Now, if you think about what that does to the rest of the electricity system, it's quite dramatic. If you look at Europe as a sort of bellwether, which has now gone significantly over 15% of electricity from these new renewables. What happened to the incumbent industries was the market share of the incumbent utilities started to crash about a decade ago because the price was being undermined by these new entrants. Now, it's a complicated story. Some succeeded in making a transition, others have never recovered. And those that helped to make the transition, in a sense, it was easier because utilities never made the supernormal profits of the oil and gas industries. But they basically, did a lot of deep thinking. Some actually split into separate divisions so that they weren't competing with themselves. They hired new people, new types of business models, and they really got to be, those divisions got to be identified as part of the solution rather than part of the problem. Mm-hmm. Now, the really interesting question is then for this audience is, so what does that mean for the oil and gas industries? And just a couple of observations. First, the big hit's been taken by coal. Something like 80 to 90% of new coal plants planned 5 years ago have been cancelled. Rather less emphasis on gas. And I would stress, I think, that in relation to Paul's point, The problem with gas is the storage regional. And I just concluded you cannot get away from that. I think that Europe now, gas demand probably is going to go down. It will play a very important role for a long time, but it's not going to succeed in a growth strategy based on the argument that it's cleaner than coal. That's not going to work in Europe.
Yeah, okay.
But it is probably part of the story elsewhere. So that's one part, and then one can turn to the transport and associated industries, and maybe we come back to that in a second.
All right, look, we've got some questions coming through on big picture, COP26, Paris. So let's get onto that now. And Robin, let me kick it off with you. Your sources, your contacts in the big oil and gas companies, what are they saying about Biden getting the US back into Paris, how much he's going to be able to achieve, what the impact will be, how much he's not going to be able to achieve? What's the general thought?
Yeah, look, I think firstly there's a very interesting divergence again between the Europeans and the Americans. To kind of put it crudely, that's not an entirely fair division, but let's say roughly. I think the European companies are happy to have a pro-climate president in the White House, which will set at least some certainty of coordinated action on climate across the Atlantic. And will make rules in a somewhat kind of a predictable way, and hopefully rules that will stand up and not get reversed every 4 years. I think the American oil industry, and if I particularly think about the smaller and independent companies, obviously just are politically very hostile to Biden, the Democrats, the idea of a Green New Deal, and so on. We'll fight that legally and as far as they can. And probably will have some success in slowing it down and watering down regulations and again possibly reversing policy if the White House changes hands again. That's a pretty big divergence. But I think sorry, actually, you wanted to ask.
No, I was going to just jump in and bring Michael and Paul in on this as well in COP26, because the question comes through on COP26, assuming it's going to take place. What are your hopes, Michael, very quickly for this? And then I'll want to hear from you, Paul. Are we really going to keep temperatures below 2%? I mean, it seems to me the consensus seems to be absolutely no.
I think that consensus depends upon which constituency one works with and interacts with. What's clear is that the global emission trends up to about 2018 didn't look like we were going to be on track. It's harder to read since then. 2019 was static. But it comes back to this point I make about understanding the processes under the hood. Because the pace of change that we've seen in some of the new industries is starting to make a dent and will do so much more dramatically. The political pressures have been rising, obviously, with the climate strikes, the youth movements and so forth. But now with COP26 and the Biden administration and the processes that unleashes, together with, don't forget, the Chinese net zero announcement deliberately preempted the White House, the US elections. And the Japanese and the South Koreans absolutely sort of went along with that they had to have a strategy recognizing that things absolutely have to change in fundamental ways. The only debate was going to be over what kind of time period. So I personally don't think we're going to stick within 1.5, but the Paris Agreement always was well below 2 and strive towards 1.5. That I think there's a fair chance that we will deliver. A much longer story, but it often goes beyond on the renewables itself, but it's what that then does to the price of low-cost electricity, which can then move into some other sectors of industry, back to that and some of the hydrogen developments, and the market of the transport, electric vehicles, etc., and the narratives around zero carbon transport companies and so forth. So these are dynamics I think are now unleashed. I don't think they can be put back in the bottle. Whether or not there was a reversal in the White House in 4 years' time, frankly, would be too late. So that is the world we're moving into. The COP26 process. Obviously, the British government has high ambitions. strong rhetoric, strong convening power through the Foreign Office networks, but also, and this is, I think, critically important, it's not like the one-off event summit to save the world. That's a complete misreading. It is, however, one of the 2 or 3 critical steps on the road to a 2023 process under the Paris Agreement, which is to do a global stocktake of consistency with the goals that were agreed, and if progress is inconsistent, what else needs to be done? So this is a 2-3 year process that will culminate with some pretty good stuff at the global level.
Yeah, okay. Paul, to that global stocktake, what do you think it's going to show us?
Well, I think it's worth pointing out that whether we get close to the 2 degrees, and I hope we do get under that, will depend very much on government policies around the world. And a point to bear in mind is that as we go forward, climate change is likely to increase the number of disastrous climate events globally. And that will start to put pressure on governments from the electorate in various shapes and forms to do something about it. So it may actually become a self-fulfilling prophecy that as climate change causes more damage, more loss of life, that there will be greater effort by governments to make sure the policy goes in the right direction.
Yeah. Okay. Thank you, Paul. Thank you, Michael. Let's bring in the second poll question here. It's a little bit of a shift in direction, but it relates to everything we're talking about in some way. Let's bring the poll up, see what our audience thinks about this. Several super majors have pledged to reduce the methane intensity of their upstream operations to below 0.25% by 2025. Do you see this target as being realistic and feasible? I mean, I don't know if one of you wants to have a crack at this and just talk openly about whether you think this is feasible. Methane gas emissions, I mean, it is quite a specific topic, this, a specific question. Robin, do you have any thoughts on it?
Yeah, well, look, yes, I do think it's feasible. Now, there's a lot of questions about measurement here, and is the methane intensity of their upstream operations actually 0.32% in 2017? But I think, you know, whatever it really is, that the reduction is not that much, and there are some very straightforward and well-known ways to reduce it. And I think, you know, we're talking here about the super majors, but actually, you know, the worst offenders in methane leaks are some smaller private companies and some national oil companies, and it is a very serious problem. And I alluded to that earlier when we talked about gas as a future fuel. You know, gas has to cut its methane footprint. It has to be as clean as possible. It won't be perfectly clean, but if it wants to play a significant role even as a transition fuel, it has to clean up methane emissions as far as possible.
Yeah. Okay. Let's see what the audience think of it. Have we got the result? Yeah, there you go. So yes, 61.5%. No, 7.7. I don't know, Michael or Robin, or Paul, if you want to comment on that. If not, I want to move it back. I've got a wary eye on the time. Yeah, go ahead. Go ahead.
Yeah, just very quickly. I mean, it's worth remembering that even if the super majors achieve that, it's not going to make a huge deal of difference, because a lot of the methane that's causing the problem is coming from other sources.
Yeah. Okay, good. Paul, thank you for that. I want to bring it back with a wary eye on the time to where I started and what I said at the beginning when I talked about market rebalancing, when I talked about a pickup in oil prices, when I talked about the supply glut and the sort of demand we're going to see. Robin, starting with you, was that too optimistic, that intro of mine, when I talked about the rebalancing, when I talked about the optimism, most thinking a summer pickup in demand is going to take out what's left of the supply glut? I mean, are there too many uncertainties, unpredictables in there?
Look, I think in the short term, the picture is looking a lot brighter. You know, oil prices are much stronger. The OPEC plus action has been overall pretty effective, and compliance is still good. And the news on the vaccines is very positive. Vaccines seem to be highly effective. Okay, some hiccups in rolling them out. Some, Europe maybe is lagging behind, but in many countries they are clearly starting to make a difference, and we're getting better and better at delivering them. And okay, we worry about new variants and so on. There's always some clouds on the horizon, but I think overall the picture is much more positive than we might have thought a couple of months ago. Big question, and Paul addressed this earlier, how much of this hit to demand that we had in 2020 is permanent? How much of these kind of conferences that we're having today online are going to replace business travel? How much are people going to work at home and not commute anymore? Versus, people have been locked up for a year. Everybody wants to fly off on a holiday this summer somewhere else, and we get a boost in demand. So there's countervailing factors as well. But no, I think in the short term, the picture is looking a lot brighter. Longer term, when we've addressed that pretty well on this event, a lot of concerns longer term, clearly.
So Goldman, I said $70 Q2, 75 Q3. Is that the top end of where you think we might be with Brent?
Well, we have an annual bet on the oil price at the end of the year with a group of the oil analysts on Twitter, and I think I might have even been the highest price that was bet this year, which is unusual because I'm not generally a bull. But I said 73 by the end of the year, so I'm well in line with Goldman on that.
Okay, all right, very good. Paul, yeah, go ahead.
I was going to make a point here to say that as we go through the year, if the price does continue to rise, and it looks as though it will, the question then arises, what impact will that have on OPEC plus compliance? Because traditionally, when the oil prices start to rise, compliance starts to weaken. So it becomes sort of a self-fulfilling prophecy that as things get better, they will get worse. And I think that's something to bear in mind, because OPEC plus is a very, very dodgy alliance, should we say. And to what degree could that... we talk about $70, $75 for prices, Q2 and Q3. I mean, how, given what you've just said about compliance, I mean, how widely could that price gyrate as a result of compliance issues? It's quite significantly, because it's as Robin correctly said, it was the OPEC Plus agreement that basically rescued the oil price and brought it back up. And if that begins to weaken, then the pressure will be downwards on price again. I mean, if you want to go further out, of course, you then get the question that given the fall in upstream investments that we've seen last year, to what extent could that lead to a supply crunch in the future? It's an industry where you've got to run to stand still. Given the lack of upstream investment, if demand starts to recover, are we going to head towards a much tighter market? And then if something happens geopolitically, we could be back into problems again.
Yeah. Okay. Michael, again, back to a question I asked Paul at the top, and well, actually, it was something Paul said. Whether is this a blip or is this a permanent shift in the way economies and societies operate, and then of course the subsequent impact on pretty much everything, including energy demand and usage. Bringing renewables in there, could renewables take a big hit if things bounce back more closely to where they were before than we think?
I don't really see anything that would suggest renewables are going to take a big hit, partly because the costs have still been coming down, both for electricity and for electric vehicles. And in fact, increasingly, it seems like there'll be a narrative that the electric vehicle is going to be cheaper, life cycle at least, than a standard one. So I think but the question is, how long will that take to impact those oil markets? And we've already alluded to gas, but just a brief remark on all this, because I think when you look back at the history of oil prices and oil price forecasts, there is always a tendency to be too influenced by the most recent trends, or the trends of the last few months or year or so. To me, the killer in this remains the shale developments and at what price they can come in, coupled with the fact that I think you probably no longer have a US administration which is going to be so keen on an OPEC plus Russia plus US trying to maintain a high price. So I could well be wrong, I'm not an expert in the field, but I'm surprised at how stable people seem to think that structure is. It doesn't feel very stable to me, given the combined pressures. And I think, as Paul himself once said, the higher the price goes, the lower it will imply for some time later. I think one thing that I would say is a surprising resilience is how much of gas still seems to be tied for oil, but that has been breaking down. And I think if there's a positive future for gas in the whole energy transition, it needs to be delinked from this level of volatility. And it needs to be as cleaned up as much as possible. Your question about methane, my reaction was, well, if we can't get it down to 0.25%, that's going to be really bad for the gas business in terms of its image in the transition. So the gas industry, I think, needs to map out a clear future, irrespective of what happens with oil and electric vehicles and so forth. What is its role in a low carbon economy as it's evolving? What is its role in relation to the emergence of potential hydrogen? We saw a big announcement yesterday on new hydrogen steel developments, which will initially be drawing upon blue hydrogen. So I think sort of delinking the oil and the gas is going to become even more important for the future of these industries. And of course, that also means looking at the expertise. Where can one use the existing industrial expertise in that kind of evolution for these companies?
Yeah. Okay. Paul, you want to give us your closing thoughts based on what Michael's just said?
Sorry?
You want to give us your closing thoughts based on what we just heard from Michael?
Yeah, it's the difficulty is knowing how the behavior is going to change as we go forward, because that will drive government policy. And I think the important point here is that the sort of the Washington consensus is now dead. The idea that we sit back and leave it all to the markets. And I think one of the impacts of the pandemic is that voters are looking at their government saying, you ought to do something about this. And so I'm looking forward in terms of an energy world where consumer governments particularly play a much more important role in the way in which things go, the direction in which things go.
Yeah. Okay, Paul, thank you. And Robin, I want to come to you just for some final thoughts as well. I mean, look, we've touched on a lot and we've jumped around a lot as well. And clearly renewables has been a big piece of this, as has COP and Paris. Again, when it comes to what you're hearing from ex-colleagues and peers in the market, what are the biggest concerns now from the big oil and gas producers?
Well, look, I think the big challenge that people are wrestling with, as we've addressed, is they have enjoyed an exceptionally profitable business, whether they're a national oil company or an international oil company, an exceptionally profitable business now for 50 plus years. How do you replace that with a business that is comparably robust and profitable? And it may well be that such a business doesn't exist in the new energy world. But there are clearly very interesting and businesses that can be very successful, whether that's in renewables, batteries, electric vehicles, electricity networks, hydrogen. I mean, there's a whole set of emerging new industries which are all poised for massive growth. But they're probably not going to overall generate the rents and the level of returns that the hydrocarbon business did. So that's really the challenge everybody's wrestling with. And if you look at a Shell or a Total, they're wrestling with it in one way. If you look at a Gulf national oil company, they're wrestling with it in another way. But the underlying challenge is quite similar. And I think the way I would look at it is that the companies and their host governments for the national oil companies are not passive spectators of this, and they certainly shouldn't be. They are actors, they are players, and they have to try to shape this new world into their own advantage. And some of them will try to delay the eclipse of fossil fuels as long as possible, which is understandable. But I think that the greatest success will be from realizing that this new world is on its way and being proactive and getting in there first with technologies and business models and establishing a strong incumbent position in some of these new industries. And you're seeing that in hydrogen, for example, which, although it's only at a very early stage, but there needs to be a lot more of that.
And to put you on the spot, I mean, who with that in mind, who would you say is being the most proactive, is doing the best job, is best placed? Not just the corporate, but the government backer too. Who would you say?
Well, I think there's a clear, I think there's a clear divergence between I would say probably the three leading Gulf NOCs, which would be ADNOC, Saudi Aramco, and Qatar Petroleum. Those three are clearly in a kind of class of their own. And then there are the laggards who, for various reasons, political reasons, security reasons, whatever, who are struggling even to keep their existing industries going, never mind getting into new industries. We know several countries in the region that are in severe political security problems. They're the ones I worry about more. If they struggle even to survive in the current oil and gas world, then the next 2 decades are going to be pretty rocky. Yeah.
Okay. Look, I am going to stop us there. We've pretty much hit the hour, and we've touched on a lot of ground. So I want to thank everyone who sent in their questions, and to those people asking for the presentation and for a recording of this. Yes, it will be available on this same link after we've finished. Michael Grubb, Paul Stevens, and Robin Mills, thank you to all of you for your thoughts and your insights and your candor on this subject. It's a big subject. There's plenty going on. There's plenty to come. My thanks to everyone today. Thanks very much indeed.